Right, good people, let's go to question 5.2 of our question bank to just revise the close corporation question 5.2. So we are going to first by starting to learn how to prepare the statement of profit or loss. We know how to do it already, so we should not take much time to learn how to prepare the statement of profit or loss. So it's Retief and Elizabeth are the only members of the Shoe Fever CC. So we can see that this is a close corporation. They each hold equal share in the close corporation. They've been appointed by Shoe Fever CC as the accounting officer for the year ended 28 February 2011. And the following list of balances were presented to you. So we've got everything there. Then we come to the issue of the required. What they want is that they want you to prepare the statement of profit or loss and other comprehensive income for the year ended 28 February 2011 in respect of Shoe Fever CC to comply with the requirements of the provisions of the Close Corporations Act number 69 of 1984 and the requirements of IFRS 1, obviously. Comparative figures are not required. Show all your calculations. So if we are doing this one now, if they say prepare the statement of profit or loss, we first see the things. We've got revenue, sales are there, purchases are there. So we are going to first start by preparing our template. So our template, from what you know, we write the name of the CC is called Shoe Fever CC. So I'll write Shoe Fever CC statement of profit or loss for the year ended. What is our year end? 28 Feb 11. Right, then you write your structure. So we're going to start with our revenue together, followed by cost of sales. Cost of sales consists of the opening inventory. You add your purchases, then you less your closing inventory. Then you get your gross profit. After your gross profit, you have your other income. Then we have selling, distribution, and other expenses. Right, let's look at our question and see the things that are there. So we have got sales there of 540,000. Open my brackets, I put my 540. Right, next is my purchases 199. So purchases, open my brackets, 199. Right, then we have got delivery expenses. These are in respect of what? Of sales. So if they're in respect of sales, those are selling and distribution expenses. How much are they? Delivery expenses on sales, it's 4920. So I'll come and say these are delivery expenses. Open brackets 4920. I'll close off my bracket when I now know that everything is covered. Right, next we have got depreciation. It has been done for us for 320. So I'll put my depreciation there. Depreciation for 320. Next is the rental income. That's income. We're going to put it under other income. So write rental income, open my brackets, it's 5450. Right, next is sales returns. Sales returns, they affect our revenue, minus 19,000. Remember, revenue is going to be sales minus sales returns minus settlement discount granted. So that's your sales for you. Right, then we move on. We are taking free marks first, good people. Right, then we've got purchases returns. They will affect your purchases. So purchases minus 4150. Then we're done. Then there is salaries and wages. Remember, when it comes to salaries and wages, we said that there is salaries to members and salaries for other employees. So you have to have two things there: salaries and wages. Then salaries to members. Don't forget. So salaries and wages, they are 236,410. Right, next is land and buildings. It's PPE, debtors control, interest on loan from member. Interest on loan from member. So the member gave the organization interest, so that will be put under what we call finance cost. We have a finance cost, so we have got interest on loan from member. How much is it? Interest on loan from member, it's 5,000. So I'm going to put my 5,000 there, open bracket. Next, we've got telephone expenses, so come and put my telephone there. How much is my telephone? My telephone expense 6,400. We've got stationery consumed 3.3. I'll put my stationery 3.3. Next is water and electricity. So water and electricity, open bracket, 7,150. We have got insurance. So insurance, open bracket, is 3.6. Next is the advertising of 4.3. So advert 4.3. Right, let me create more space there in case of other things. Alright, we've got selling, distribution and other expenses. Right, so we are done with the free marks. Now we come to the additional information, then we make an adjustments. So they are telling you that inventory on hand on 1 March, so this is the beginning of year. Remember, our year ends on 28 February 2011, so we are starting from the 1st of March 2010 until 31 March 2011. So in this case, 1 March 2010, that's our opening inventory. So I'll come and put my opening inventory of 23,000. I've got opening inventory of 23,000. Then it's inventory at the beginning. Please take note, good people. That's why I'm putting it under opening inventory. Then we obviously have closing inventory. Where is the inventory? Here, 60,000. So we've got 60,000 there. So remember, it's opening inventory plus purchases less closing inventory. So that will give us the cost of sales. Right, in case there are adjustments that we have to make. Then they are saying that there's an interest on long-term loan from Mercy Bank at 15% per annum must still be accounted for altogether. And the loan was obtained on 1 March 2009 and is secured by a first mortgage over land and buildings. The long-term loan is repayable in 4 equal installments from 1 March 2011, that is next year. So the interest on loan, it's 15%. It was received on 1 March 2009, that was before. So it was a full year. In the current year, it will be 15% multiplied by, where is the loan interest on loan? I can't see it. The loan from Mercy Bank, yes. They are saying that it is 112,000. So it will be 15% times 112,000. It will give us 0.15 times 112,000. That will give us 16,800. So that goes under all interest, will go under finance cost. So that's interest on loan. It will give us 16,800. Right, next. So we're done with that part. Mr. Sell, a debtor who owes shoe fever CC 3,000, was declared insolvent and his debt must be written off as irrecoverable. Remember, bad debts written off are called what? Credit losses. And your credit losses as a line item in the profit and loss account, you'll be having a bad debt like what we have there, plus an increase in allowance, less a decrease in allowance. Right, so an increase in allowance is then when an allowance for credit losses increases, and a decrease is when the allowance for credit losses is what? Has decreased. So we can come and we say credit losses. This guy is not able to pay how much? 3,000. So we're going to come and put 3,000. Then we check if there was an increase or a decrease in the allowance. So in this case, 2.4, they're saying the allowance for credit losses must adjust to 3,000. How much is the allowance that we have on our trial balance? Whereas the allowance for credit losses is 2,000. So meaning that the allowance is going to be 3,000 minus 2,000, meaning that it moved from 2 to 3. So there's a difference of 1,000. So it's an increase. So we are going to add it to our credit losses plus 1,000. That is going to give us 4,000. Right, then we come to 2.5. The loan from Retif pays interest at a rate of 10% per annum. Altogether, this is a Retif loan from Retif. Retif is a member. So loan from Retif, it is an expense for the entity, which is an interest on loan from members. So the interest loan from long-term loan there's nothing there. Yes, loan from Retif, it's 50,000 there. So he was given a loan of 50,000, so we're going to say 50,000 multiplied by 10%. They did not give us the period, so we assume that it was a full year, which gives us how much? 5,000. So when we come this side, we can see that the interest on loan from member that was paid was 5,000. So it is all fine. There is no adjustment that should be made there. 16,800 plus 5,000, assuming that there is no other. So we have 21,800 for our finance cost. Right, then we come to the next one. The insurance expense include an amount of 300 relating to the insurance premium for March 2011. Our year end is, I wrote a wrong period there. It's from 1 March 2010 until 28 February 2011. Are we together? So our year is ending on 28 February 2011. So therefore the expense of 300 is an amount that should not be there because it relates to the next year. It's a prepaid expense. So we are going to come and we say how much is our insurance. Our insurance, the correct amount on our trial balance is 3.9 minus 300. Then you are left with 3.6. Sorry for that. Right, then next we are done. 2.7. Port Elizabeth is entitled to a salary of 5,000. Retif and Elizabeth, they're entitled to a salary of 5,000 each. Remember, we said the salaries to members should be disclosed separately. Are we together? So if they are included in the salaries, they should be taken out. Are we together? Then they disclosed separately. So they are getting a monthly salary of 5,000 each times 12 times 2. They are 2. So it's 5,000 times 12 times 2. You get a total of 120,000. So the 120 will take it from the salaries minus 120. Then we put it on 120 to the members. Out together, salaries to members 120. So it will be 236,410 minus 120,000, which gives us 116,410. 116,410. I hope you can follow. Salaries to members, they are shown separately. Then we move on to the next item. The income tax for the year amounted to 26. So there's no adjustment. They told us that the tax for the year is 26,000. So we are going to be having our profit before tax. Profit before tax. Then we have our income tax expense, which they said is equals to 26,376. Then you have your profit for the year. After profit for the year, you have your other comprehensive income. Then you have your total comprehensive income. Right, so basically what we can say, we are done with the preparation of the profit and loss account. So you can close off your revenue amount. Then you get 521,000 there. Purchases 199 minus 4,150. You are going to get 194,850. then you add 23 plus 194 minus 60, it will give you 157,850. But this I guess you can also check on the solution. Then you have the revenue minus cost of sales, you get a gross profit of 363,150. Other income, there's only one item, which is rental income. We close 5,450. This will give us a total of let's not rather put a total. Then selling, distribution and other expenses, you close off everything, so that will be 4.3, 7,150, 3.3, 6.4, what else, 4,320 and 4,920. I hope I took everything into account. Then you get your 274, so it will be 274 400. Then that will give you that profit for the year, which will be 72 400. Other income, nothing. So total comprehensive income will be 72 400 is profit before tax. Then profit after tax, profit for the year will be 46,024. 46,024. So that's how you prepare your statement of profit or loss and other comprehensive income. Right, thank you very much, good people. Let's look at another question. Dumisani CC. Right, question 5.5. Dumi and Sani are the only members of Dumisani CC. They have an equal interest in the corporation and distribute profits accordingly. So on 29 February 2012, the financial year end of the closed corporation, the bookkeeper presented the following information to the accounting officer, who is also required to prepare the financial statements of Dumisani CC. Now the members' contribution, everything is given. So our year starts from the 1st of March 2011 until 29 February 2012. That's our financial period. Right, they want you to prepare, or they want you to calculate the total comprehensive income and the statement of net investment. So before we do anything, we first write our structure. What is the name of the closed corporation? It is Dumisani CC. Statement of profit or loss. Here remember they want you to calculate statement of profit or loss and other comprehensive income. Then we come to the Dumisani CC. This is the statement of net investment. For the year ended 29 February 2012. So we have to check how many items are we going to be having under our statement of net investment. We have members contribution, we have got loan to members, loan from member, we've got the asset replacement reserve, we also have the retained earnings. So we should prepare 5 lines there. So it will be 1, 2, 3, 4, 5. This is too big. So you have your balance at beginning of year, followed by total comprehensive income. You might be having distribution to members. Then let me put my balance at end of year. Right, so then we come to the profit and loss account. Which items do we have? We take Freemax first. So the profit and loss account, there's no revenue, there is gross profit. So we'll start with the gross profit. They said the gross profit is how much? Our gross profit is 922,000. Next, we have got, obviously, after gross profit, other income. Then jump a few lines, we have got selling, distribution, and other expenses. Right, which items do we have? So we have been given gross profit, mortgage, investment, allowance for settlement, discount, retained earnings, interim accumulated depreciation, prepaid expenses, allowance. So there is taxation, and this is what? General expenses before taking any applicable additional information. So that's an expense. General expenses before adjustments. So meaning that we have to adjust with the additional information there, which is giving us 629,000. Right. Then we are done. Then we start. Number 1, we've taken all the Freemax. Number 1, on 31 January 2012, which is during the year, we made an additional cash contribution of 80,000. But before I go there, the statement of net investment, we can take Freemax. Anything that was there at the beginning of the year, that is the 1st of March 2011, should be a Freemax. So there is nothing, okay, there is only retained earnings of 577. So balance at the beginning of the year. Oh, I didn't write the name of the accounts. So this is the members' contribution. Then I put my retained earnings. What else did we have? We had loan from, let me write it neatly. So retained earnings, we have got loan from members, we have loan to members, and the asset replacement reserve. So we've got balance at beginning of year, followed by total comprehensive income, distribution to members. Right, so in this case we said the first one is the retained earnings at the beginning of the year of 577,000. So that was the only item given at the end. The other items are at year end. Right, so we start. They told you that on 1 January 31 January 2012, Dumi made an additional capital contribution. So the capital contribution will obviously go to the members' contribution. So we can say members' contribution. Members' contribution. They said he contributed how much? 80,000. Right. Then we are done with that part. An additional amount of 2,000 owed by a debtor of the business must be written off. So therefore, in our expenses, we have our credit losses, which we said credit losses is your bad debts plus an increase minus a decrease in allowance. So our credit losses here, they are saying that they are 2,000 rand. Then we check if there was an allowance. The allowance for credit must be adjusted to 40,050. How much is the allowance for settlement discount there? Not allowance for credit losses. The allowance for credit losses, it is 5,000. So meaning that it will be 5 minus 4050. Therefore, it is what? Decreased. So if it is decreased, it means that we are going to also reduce our credit losses. It is decreased by 950. So it's 2,000 minus 950. That will give you 1,000 and what? And 50. Right, done there. And then on 1 August 2011, Dumisani CC concluded a contract for insurance policy. The policy was incepted on the 1st of September 2011. So a premium of 800 per month. During the year, a total of 5,600. We don't care about the money that was paid in the profit and loss. We care about the months that were used for this insurance. So if it was started on September 2011, so it would be September, October, November, December, January, and February. How many months is it? 1, 2, 3, 4, 5, 6. So our insurance. So I'm going to come there and I write my insurance is 800 multiplied by 6. They told us that each month it's 800 times 6, which is 48,000. Right, next. Right, so we are done there. Then number 4. Number 4, they are saying that the members decided that for the 2012 financial year, the interest must be recorded on the loan accounts to members at a rate of 10% per annum. So this interest must be recalculated on the balances of any existing loans. So on that 1 August 2011, an additional loan of 20,000 was advanced to Dumi. So Dumi, we are going to give Udumi a loan. So we are saying loan to member. This is a loan to was advanced to, so it's a loan to member of how much? Of 20,000. Loan to members, so 20. So the loan to members, I will put them in bracket because these are assets. All these other items have got a credit balance, but the loan to member is an asset, so I'll put it in brackets. Loan to member, 20,000. Then they are saying the interest on loan is to members is capitalized, so meaning that the interest that we are going to incur, or the interest that we are going to receive, we are not going to get cash, but we are going to add it on top of the loan account of the members. Are we together? So when we are looking at the loan to member Dumisani, had 70,000 at the end of the year, and Usani had 35,000 altogether. But we can see that the 20,000 was received on 31 August 2011, which is how many months there? So it will be September, October, November, December, January, and February. So which is also 6 months. So 70,000 was there for a full year. So come and subtract 20, 70 minus 20 multiplied by 10%. Then the 20,000 was only there for a short period, which is 10% times 6 over 12. The 35,000 was there for a full year. There was no information about that. So this will give us 5,000, 3.5, 10% of 20, that's 2. That will give us 1,000. So all in all, 8.5. That will give us 9,500. So what do we do with the 9.5? The 9.5 is interest income, ain't it? So we are going to put it under other income. Right, so interest on loan from member, it is going to be 9,500. Right, so we're done there. Then there's an loan from Dumisani. The loan from Dumisani is a finance cost. Right, so the loan from Dumisani, where is Dumi? The loan from Dumi, it's 105,000. So the interest on loan, it was received, they didn't tell us, so we assume that it was a full year. So the loan is 105,000 multiplied by 15%, which will give us 105,000 by 0.15, which will give us 15,750. That's a finance cost, dang it. Finance cost, interest on loan from member, 15,750. Right, let's go to number 4 again. There's something that we left out. Remember, they said interest is capitalized, so we are going to come and we add the interest capitalized on our statement of net investment. The interest capitalized, we had calculated it as what? 9.5. So it is adding to the loan to members because it is not going to be paid. Right, then so that's that. In view of business conditions, the members decided to adjust the allowance for settlement discount granted to 2,000 altogether. So the settlement discount, we are saying that it's an expense for the entity because you have adjusted the income that you were expecting to get. So if you had sold your assets or maybe your goods at 10,000, then you tell your customer, if you pay within 5 days, we'll give you a 10% discount. So if you sell them for 10,000, it means that the customers are going to pay you 9,100, which is 10 minus the 10% of your selling price, which is 10 minus 900, then you get 9.1. So it is an expense. So you make an allowance for that, like what you do with your credit losses. So the allowance for settlement discount granted is 1.5. Now it is adjusted to 2,000. So we come there and we say 2,000 minus 1.5, we get 500, and we can see that it has increased. So therefore, if it has increased, it is going to increase also our expenses. So we can say allowance for credit losses 500. It's an expense. Right, then next, they are to transfer 20,000 in the retained earnings to asset replacement reserve that we can see in the statement of net investment. So we can say transfer to ARR. So it will be coming from the retained earnings, then we add it to the asset replacement reserve, which is 20,000. So it's a minus there and a plus there. Right, then we move on. Right, 6 is done. Come to 7. Number 7, they are saying that there's an investment in Voda Limited. They've got 80,000 shares in Voda. They were purchased on 1 March at 450. So the cost of the investment is 80,000 multiplied by 450, which is 80,000 times 4.50. It will give us 360,000. Right, and then on 28 February, Voda declared a dividend. So there was also dividend received of 80,000, and each share is 0.30. So that should give us 24,000. So there are two transactions that we have. This investment is at cost. So we have to check now that is the value increased or decreased, which is the revaluation. We call that fair value adjustment for shares held for trading purposes. Right, because the investment is Voda, there is no PTY. The shares are held for, we can say, speculative, sometimes speculative purposes. Right, so in this case, we have got dividend received. That's the first thing that we'll start with. It's other income. Dividend received. We say it is 24,000. And then the next thing now is the fair value adjustment. The cost of the investment is 360. When we check at the fair value of the investment on our trial balance, they are saying that the investment, where is the investment? At fair value, it's 400. So it means that the investment increased from 360 and it went to 400,000. So meaning that here the amount, the cost was revalued to 400,000. So that we call that a fair value adjustment in the profit and loss account. So I'll come and put my fair value adjustment for shares held for trading purposes. It is equal to 40. Right, next, number 8. On 20 February 2012, the members decided that an amount of 80 must be distributed to them. So let's write note about distribution to members. So whenever there is distribution to members, there are two types of distributions that you have to take into account. Number 1 is the interim, and number 2 is the final. So the interim, these are profits that have been distributed during the year. Let's say the entity was making a lot of profits, then they say, no, let's just pay each other profits. So that's the interim. Then the final is what they are going to declare at the end of the year. So when they declare the end of the year, sometimes this amount will not be paid in the statement of financial position, because it has not yet been paid, meaning that the entity is now owing the members. So it is going to be shown as distribution to members payable. Right, so how much is our interim? So in this case, we are going to add the interim and the final. So they said they decided to, so there is a final of 80. Then we check on the trial balance if they paid anything. They say there's an interim profit distribution to members of 40,000. So we are going to add interim is 40. So we add the two. We are going to get 100 and what? And 20,000. And this amount goes to the statement of net investment altogether. So this is the distribution to members. 120 will come from retained earnings because they are distributing the profits. Right, so we are done. Then the income tax assessment was received on 5 March, indicating a balance of 20,600. Please take note, it is due to, meaning that SARS is now owing to Misani. And how much was the tax in the trial balance there? It was 116. So we come in the profit and loss account and we say profit before tax. We have our profit before tax, whatever amount that you get. Then you come and you state income tax expense. So the income tax expense on our trial balance, it's 116,600. We take out what we overpaid by, which is 20,600. So 116.6 minus 20.6, it will give us 96,000. Right, so then you will be done. Then you get your profit there. Right, I'll just take the profit is 248,400. So the profit that you get there, please take it as it is in the statement of net investment under total comprehensive income. So you are going to put your 248,400. Right, after this we are done now. Let's go back to the trial balance and check now any items. So we are going to start by closing off the members' contribution. The reason why I did not put the amount at the beginning, because the balances were given at the end. So at the end, the members' contribution was 215 plus 125. So 215 plus 125. So the amount is going to be 300 and what? And 40,000. So the 340 will be at the end. So therefore the opening balance will be the balancing figure minus 80. It is going to give us 260 there. Retained earnings, the opening balance is given. We add 248 minus 20 minus 120. You can get 577,000 plus 248,400 minus 140, which gives us 825,260. This is wrong. I'll just take it there. You correct it. 725,400. Loan from members. Loan from members at the end of the year. The loan from members. The loan from member, which is due me, 105,000. So it did not change. It's 105. Nothing happened during the year, so we put 105,000 there. Are we together? Right, so let's look at the loan from members. Now the loan from members, now we have to show the non-current liability and the current liability. Right, what do we mean by non-current? Non-current is the amount that is going to be paid in a period of more than 1 year. Then the current liability is the amount that is going to be paid in a period of less than 1 year. So the current liability, if we go to our question, they said on point number 4, it's not number 4, yes, it's point number 4. The members decided that for 2012 financial year, and no, this is loan to members. Okay, it's point number 5. Number 5. Interest on loan from Dumisan bears an interest of 15%. We have done that. Then the loan is unsecured and 20% thereof must be paid on 1 August 2012. Our year end is 28 February 2012. So meaning that this amount is going to be paid in a period of less than 1 year. So therefore it will be equal to a current liability. So if it is a current liability, now we are saying that the amount that is going to be paid in a period of less than 1 year will be 20% times 105, as they said, which gives us 21,000. The non-current obviously will be 80%, or 105 minus 21, then you get 84,000. Right, let's go to the loan to members. The loan to members, on our trial balance, the loan to member, there is 70,000 and 35,000 at the end of the year. So at the end of the year, it will be 70 plus 35. I'm going to add the 9,500. Why? Because it has been capitalized. So it will be 70. It will be 70 plus 35 plus 9.5. You get 114,500. Please correct what they have there on their solution. You get 114,500 minus 9.5 minus 20,000. So it's 20 plus 9.5 minus 114.5. It will give us an opening balance of 85,000. So this, because it's a debit balance, that's why I'm putting it in brackets. Then we come to the last part, that is the asset replacement reserve. With the asset replacement reserve, how much did we have under the asset replacement reserve at the end of the year? It was 80,000. So I'll put it at the end, meaning that when we opened, it will be 80 minus 20, you get what? 60,000. So that's how you do your calculations there. Right, so that's how you prepare your statement of net investment and the calculation of when they say calculate the profit for the year. So that's how you are going to do it, good people. So please look at the other questions in your study guide. Try to do all of that. Do all the questions in your study guide. Also look at other questions on the question bank. Right, when we meet next, we are going to be doing what we call the statement of cash flows. Right, also look at the statement of financial position there. We're going to look at that when we are doing our exam revision. So for now, statement of cash flow. Let's look at that, then we deal with that. So I hope you can follow what we are doing. Thank you.